Hello, my name is Noel Cardona. I specialize in investing in Liverpool and Wirral, and if you have properties, HMOs, buy-to-lets that you want managed over there by us, please let us know. If you want to invest in those sort of strategies over there, please also let us know. We know really well the zone, the market, and can give you a big hand in your journey towards keeping or achieving your financial freedom. Now, in this presentation, let's talk about tax, the new tax landscape, which is always evolving and that you as an investor need to know really well. First of all, what we are going to talk about here today is, first part of it is the investors who have properties in their own personal name. The second part is the investors who have those assets in limited companies, and why nowadays there is a massive transition towards being in their personal name to being limited companies. Now, none of the models is perfect. They all have their own difficulties, but as in any investment, everything is an approximation and you try to move to the most efficient way, which is not always 100% efficient, if you know what I mean. Now, let's talk about those investors who have or who are thinking about holding their property in their personal name and understanding the new normal for those investors. Very important. Now, there is something called Section 24 that you might already have heard about, and is the tax which I think is George Osborne introduced for landlord, and this changed everything. As of April 2020, the landlords who have their properties in their own name can no longer deduct any mortgage as interest from the rental income, right? And this is a massive issue, because this effectively has meant for landlords with properties in their own name that they have a business which is being taxed on the revenue and not on the net income. Massive change, massive attack to those landlords who have worked hard for their money and that they've been attacked in this way. It's a massive tax that is meant a lot of movement and a lot of rethinking for many of the investors. Now, the new system is basically you can only deduct 20% of your mortgage interest payment. So if before you paid, for example, interest only mortgage, and you paid £1,000, you could deduct the £1,000. Now you can only deduct £200. That, in a simple form, is what Section 24 is. And there you can see the massive impact in any who had a buy-to-let or a HMO on their own name or any other property on their own name. Now, this mainly will impact higher rate taxpayers, which are 40 and 45%. If you do the numbers, then that effectively, the more you earn, the more it's going to affect you. This is effectively a government attacking landlords and attacking the people who know how to make the money, who know how to increase the economy, who know how to grow that economy themselves. Very, very important, and very difficult to understand why a government is working against those who invest and who create rooms, properties for people who want to rent. Very difficult to understand, but that's the reality. As I said, you are taxed on turnover and not profit, and this is just a business you don't want to have. Definitely not, and that's why this big Section 24 is the single most significant negative change for individual landlords in the last decade. Thank you to the politicians who have done this. Now, let's do an example, a simple example on this. So let's assume you have £20,000 in rental income, 10,000 in mortgage interest, and you're a 40% taxpayer. In the old system, which was pre-2017, you would have the rental income, mortgage interest of 10,000. You would deduct the 10,000, and then the tax due on that would be 4,000, because you can deduct the total interest in that mortgage. Now, the new system is, for example, you have £20,000 in rental income, taxable profit is 20,000, a tax on that of 40%, 8,000, less the 20% credit on your 10,000 mortgage interest in the mortgage, that's 2,000. Now you have a total tax due of 6,000. That's nothing else, nothing less than a cost increase of £2,000 in that calculation, 50% more tax. Very important for you to know this, and that's when we do investments for people who are just starting the process, because that's part of what we do. We take investors by the hand and take them from organizing this tax strategy, taking them down to finding properties, refurbish them, renting them, and getting them managed. We do the whole thing. That's why we tell them this, because this is extremely important. They understand this, understand the impact of it. Again, none of the models are perfect, but this is why you need to plan how you're going to hold your businesses before even you begin. Because of this, this is such huge change, or such a huge decision in the process. Now, other key changes for you holding property on your personal name. From April 6, 2024, the residential property capital tax gain, which is CGT, was reduced from 28% to 24%, and the basic rate remains 18%. Well, that's a rare piece of good news. Now, no such a good news is that stamp duty is being increased, keeps increasing. Now they're talking about trying to change it in terms of paying stamp duty to do a national insurance payment on properties, which you will have to pay every year. Again, more and more attacks, making it more difficult to invest in the UK. And this is the surcharge increase from 3 to 5%. It depends how you're buying properties, but if you're doing it in your own name, you used to pay 3%, now you're paying 5%. And from April 2025, which some months ago, this year, the nil rate band reduced from 250,000 to 125,000, which means that before, if you were buying a property, for example, for 150,000, you would not pay stamp duty. Now that's decreased, and you would be paying stamp duty on the same investment. That's where it's coming from. Very difficult again for investments. And then if you have Furnished Holiday Let from April this year, all tax advantages, like your full mortgage interest review, relief, are being abolished. So Furnished Holiday Lets will be taxed just like a standard. Again, the government seems to think that the businesses based on property have limitless cash to pay taxes, and that's a very difficult one, because it's not easy for any investor who has properties and does their best to provide good accommodation and then keep those properties alive. And if this pressure continues, probably they might cause the beginning of a property crash over the long term, I can say. Now, there is another change which is going to increase the costs of your operations as a landlord, which is this one. The HMRC have introduced that from April 2026, landlords, and this is with income over £50,000, and this is not per property but accumulated, must keep digital records and submit quarterly updates to the HMRC. And in 2027, this drops to 30K. So if before you used to do a one tax return per year, now you'll have to do 5. I want to pause for you to understand that you not only you have to keep digital records, okay, like use a software for your records, and then your accountant will have to do not 1 but 5 tax returns. And if your accountant is been charging you £150 per return, if you're lucky, then that times 5, you're going to end up paying more than £700 now a year because of these reports, unless you are doing them yourself. But then again, I wanted to show you this because this is the massive increase of costs through additional regulation and just make it more difficult for landlords, especially the ones who have, as you might do, properties in your own name. Very, very important to understand. Now, let's compare that to holding properties in a limited company. Now, this is not perfect, but this is the reason why 4 of each 5 properties are being bought through limited companies now in the UK. Now, when you own a property through a limited company, Section 24 does not apply, because a limited company is a separate legal entity and it's not you, it's a business as such. And as such, you have new responsibilities, like if you are a director, you need to do an annual confirmation statement, and you need to do the tax returns, and all of that comes with it. But the section 24 does not apply. And then you, as with any business, you do your profit and loss, you reduce your mortgage interest. If you are in a interest-only mortgage, then you do that. If not, you can only remove, claim the interest from the revenue, and your tax on the net income. So again, this is why taxation, the company pays corporation tax. Here, as you know, the corporation tax can change as the government determined, so it could be higher, could be lower. At the time of recording this video is 19%, but again, you have at least that possibility of deducting. Now, to make a parallel between owning property in your own name and as a limited company, for some cases, if you do the numbers, both could be okay, both could be right because of the differences in costs. But it's important for you to know that this exists, and probably, and me, at least in my opinion at the moment, the limited companies offer more advantages, not only on taxes but also in future inheritance, depending on the size of portfolio that you're planning to build. Very critical. Now, corporation rates, as I said, it's 19% if your profits are up to 50%, profits, not revenue. 25% if they are about £250,000. And there's a marginal rate between these two. So all of the expenses, very, very important. So for example, if you have a property in your personal name, you might end up paying £6,000 as property tax, and we just saw that in a minute ago. Now you have in a limited company, then you have a rental income of 20,000, your mortgage interest is 10,000, profit, a taxable profit is 10,000, and then corporation tax at 19% is 1. This is not perfect, and I'll tell you why in a minute. Now the tax saving in this comparison, again, this is for a tax at 40%, not a basic rate. So again, the situation of each investor is different, and it changes dynamically as you grow your cash flow and your income. But this will give you a framework to understand this. The tax saving in this comparison, this example, is £4,000 very, very critical that you understand these numbers and know where they come from. Now, as I said, it's not perfect. The limited company is not perfect, and the 1900 pounds tax is only the first step. Because if you wanted to get that money out of the limited company, you would have to pay a second tax, which via dividends. All right, so you have the first corporation tax and then you have a second tax there. But at the least you have a choice, and the choice is to reinvest that money in the limited company to grow your portfolio. Now, as of 2024, 2025, your tax-free allowance is 500%, so 500 pounds, which was reduced from 1,000. Again, the government pushing to extract money out of what they believe are rich people. And I don't believe that every landlord is a rich person. The reason why is 70% of landlords are accidental and they inherited the properties and they just want to have a side income. They don't have huge portfolios, but that's what the government seems to think, that each landlord has billions in their pockets to pay as much tax as they need. And that's not the case. This is the basic taxpayer rates, which at the moment exist, and then it can change. Now, the key takeaway on this, and I'll explain this in a second, is basically that the limited companies are most tax efficient if you plan to reinvest your profits, as I said before, to buy more properties. And in the long term, that's what a professional investor does. They want to invest, hopefully creating a lot of value in each of the properties, and then reinvest those profits to create and buy more properties, and to grow that portfolio. At some point in the future, sell part of it and pay the debt on the other part, and then liberate those assets and hopefully keep those for generations to come. That's the idea, and that's a very, very common strategy. Now, if you are investing in property to remove or extract that money, those profits, very often, then you will have a second tax, which will make it. And again, it's a game of numbers. It's a game of how you claim as much as possible through a limited company in this case, and how you make it work in a way is efficient. Again, no model of ownership is 100% efficient. There are some that are more efficient than others in that space of time, because it dynamically changes as per the government changes it. Now, just to explain this a little bit more, for dividends, you take out 5%, 500 pounds, up to 500 pounds free of tax, and then the rest that you take out is charged at these levels depending on your personal income. That's what it means. Now, other considerations. Higher mortgage rates. Normally when you have limited companies, the mortgage rate increases 0.5 or 1% at the moment, compared to for buy-to-let companies, which when you buy through a limited company, normally there's an additional surcharge for just buying into a limited company. Even if it's your first property, you'll pay a surcharge just for buying as a limited company. Again, the government trying to squeeze money from what they believe are rich landlords, which is not the case, definitely not. And then the admin side of things, it requires some additional work. But again, we do it for many different limited companies. When an investor comes to us, we manage the property, we manage the accounts, the accounting, the report, and is a very low fee we charge for it, because we do it again and again, and we have the team to do it with no complications and doing it correctly. That's the way it should work. Now, some summary key timelines. In April 2020, just historically, so you can connect the dots, we had this horrible section 24 implemented, and we just explained what it was. Then in 2024, we had a higher rate for CGT, residential property, which was reduced from 28% to 24%. The stamp duty in 2024 in October, they increased it from 3% to 5%, and then they reduced the threshold for the stamp duty, and the FSL, Furnished Holiday Let, was abolished again. And now the making tax digital is making more difficult for those landlords who have the properties on their names. By the way, this making tax digital of 5 different reports per year was also being proposed for properties being held in limited companies, but it was scrapped at the last minute. But it remained for those landlords who have those properties in their own name. Now, let's summarize. So if you have properties in your personal name at the moment, or you want to buy your personal name, you need to think about the high tax environment that the government has created, especially if you're buying with a mortgage. If you're buying cash, you only have to deal with the stamp duty issues. But if you're doing with a mortgage, then you know that Section 24 is being a gift given to you as a landlord. If you're buying through a limited company, it's a good strategy if you want to reinvest those profits. The efficiency is high, the same as many businesses which are held through a limited company, but there is double taxation through dividends. If you have any questions, please let me know at info@propertycashflow.co.uk, or send me a message at 07411 904 124, and we can continue this conversation. But hopefully I gave you a very good picture of what it means